Imagine having just a line of customers wrapped completely around the block.
Right.
And all of them are holding cash. Like they're practically begging to give your company $500 billion.
Which sounds like the ultimate business fantasy.
Exactly. But then, and here's the catch, imagine having to fire 30,000 of your own employees. Just gutting your workforce.
Yeah.
Just so you can afford to take out $1 billion loan at, punishing interest rates just to buy the stoves and the fryers to cook the meals for that line of people.
I mean, it sounds like a completely broken business model.
It really does.
You have this unprecedented demand, but the physical cost of fulfilling that demand is, well, it's literally tearing the company apart from the inside.
Right, exactly. And that bizarre upside-down reality, that is not a hypothetical scenario.
No, it's not.
It is exactly what is happening at the very top of the global technology sector today. So, welcome to the Deep Dive. It is Wednesday, June 10th, 2026, and we are absolutely thrilled you could join us. We've got a stack of sources today that is, frankly, just a highly volatile and fascinating mix of raw data and institutional panic.
Yeah, it's a collision of some very distinct economic forces right now. We are looking at the brand new and honestly rather alarming consumer price index data from the U.S. Bureau of Labor Statistics.
Which is a heavy read.
It is. And alongside that, we have a highly anticipated and very tense monetary policy press release from the Bank of Canada.
Right.
Plus several really dense professional-grade institutional capital flow reports. And finally, the big one.
Oh, yeah. The S1 financial filings for what is about to be the largest, most disruptive stock market event in human history.
The upcoming SpaceX IPO.
Yeah. So our mission for you today is to make sense of a day where raw geopolitics, sticky inflation, a complete paradigm shift at the world's major central banks, and the brutal fiscal realities of the AI boom are all violently colliding.
It's a lot to untangle.
It is. We want to connect the dots between military strikes in the Middle East, the exact price you were paying at the grocery store, a staggering $1.75 trillion space IPO, and what it actually physically takes to build the AI future. Okay, let's unpack this.
Well, if you look closely at this stack of sources and you strip away all that daily market noise, there is a really powerful underlying theme emerging here.
Which is what?
We are witnessing the global economy violently shifting from a 15-year era defined by cheap money and lightweight software into this new, really unforgiving era of incredibly expensive capital and heavy physical infrastructure.
Cheap money and lightweight software versus expensive capital and heavy infrastructure. I love how you framed that.
Thanks.
And to really understand the mechanics of that shift, we actually have to start in the physical world. Wow. Because right now, raw geopolitics is dictating the numbers on your receipt at the store and the red numbers flashing on trading screens. If you look at our institutional reports, the spark for this current wave of market volatility happened near the Strait of Hormuz.
Yeah, a U.S. Army helicopter actually crashed in that specific region.
Wait, a helicopter crash?
Yes. And following the incident, President Donald Trump publicly blamed Tehran, and the U.S. military subsequently executed targeted strikes against Iranian infrastructure.
Okay, and just to pause here for a second, because this is crucial for you listening. I want to make it unequivocally clear that we are maintaining strict political impartiality in this discussion.
Absolutely.
We are looking at these military and political actions purely as factual market catalysts, exactly as they're laid out in the institutional source material we're reviewing.
Right. We are not endorsing, we're not condemning, and we're not taking any sides regarding any political figures' actions or, foreign policy decisions.
Exactly. Our sole mandate today is to dissect exactly how these physical events ripple through the global financial system.
And I mean, that ripple effect was instantaneous. It manifested as a massive energy shock.
Why so fast, though?
To understand why, you just have to look at the geography. The Strait of Hormuz is arguably the world's most critical maritime choke point for global oil distribution.
It's tiny.
Very narrow. A massive percentage of the world's daily petroleum supply literally has to float through that narrow stretch of water.
So it's the ultimate bottleneck.
Precisely. So the moment military friction escalated in that specific bottleneck, the crude oil market, they didn't wait to see if a tanker actually got hit.
They never do.
Exactly. The market immediately priced in the risk to commercial vessels. Insurance premiums for maritime shipping companies just skyrocket overnight.
Wow.
The potential disruption of supply gets baked into the price immediately, We saw Brent crude, which is the major international benchmark for oil, spike to $93.89 per barrel.
Which is a staggering jump when you realize that the pre-war baseline, just back in late February, was sitting comfortably around $70 a barrel.
Yeah, it's a huge move.
And the benchmark for U.S. crude West Texas Intermediate, or WTI, rose to $89.46.
Right.
Now, you might be asking, why does a spike in a barrel of crude oil matter so much to the broader economic narrative? Like, why are we talking about it?
Because energy is everything.
Exactly. It is the baseline input cost for literally everything in the physical economy. If it moves, if it's manufactured, if it gets delivered to your door, it requires energy.
And we saw that exact painful reality reflected in the May 2026 Consumer Price Index data that just dropped from the VLS.
Let's get into those numbers.
So the CPI report is essentially our diagnostic tool for the health of the consumer economy. And right now, it is showing a serious acceleration of inflation.
Yeah, headline inflation rose at an annual rate of 4.2%.
Which is a massive psychological and economic barrier. It is the first time headline inflation has breached that 4% threshold since way back in April of 2023.
That's 3 years ago. And when you look at it on a month-over-month basis, headline inflation was up 0.5% just from April to May alone.
Yeah, but the real story is in the aggregates. When you dig into the underlying categories, the energy index alone surged 3.9% in a single month. Retail gasoline at the pump was up a staggering 7% in 30 days.
7%.
Yeah. Fuel oil was up 3.8%. So that geopolitical shock we just discussed in the Strait of Hormuz.
It isn't just a headline on the evening news.
No, it is already actively draining your wallet at the gas station.
However, there is a really fascinating contradiction buried in the granular data of this report.
There is.
While energy prices are exploding upward, the prices for core goods actually fell 0.1% in May.
Right, which is so counterintuitive.
For example, the data shows that new vehicle prices dropped by 0.3%, and household furnishings dropped by 0.6%.
Wait, really? Cars and furniture actually got cheaper?
Technically, yes. What that drop in core goods suggests is that the direct inflationary pass-through from global tariffs that we saw earlier in the year has at least temporarily stabilized.
Okay, so the initial shock wore off.
Yeah, retailers and global supply chains have either absorbed those initial tariff shocks into their margins, or they've successfully adjusted their sourcing. The initial panic pricing on physical goods seems to have cooled down.
Okay, so it's sort of like trying to compress a water balloon.
Ooh, I like it.
You push down on one side, the core goods side, the furniture and the cars, and you manage to get that side to compress slightly.
Right.
But you haven't actually removed any water from the balloon.
No.
The pressure just transfers, and the energy side of the balloon bulges right out, completely negating the progress you made.
That is a great analogy. But I really want to push back on this cooling goods narrative for a second.
Okay, go for it.
If things like furniture and new cars are technically getting cheaper, or at least, stabilizing in price, why does every piece of source material we have indicate that everyday consumers and small business owners still feel so incredibly, suffocatingly squeezed?
Yeah, that's a good point.
Like, why isn't a 0.6% drop in a sofa providing any actual relief?
That is the vital question. The disconnect between a technical drop in goods and the psychological reality of the consumer comes down to two major factors.
Which are?
The stickiness of service costs and the punishing cost of capital. Yes, you might theoretically pay slightly less for a sofa today than you did a few months ago, assuming you are even in the market for a sofa.
Right, which most people aren't doing every month.
Exactly. But the CPI shows that shelter costs, which means rent, and the cost of housing, are still up 3.4% year over year. Apparel is up 4.8%.
And shelter isn't a discretionary purchase like a new car. You have to pay rent every single month.
Exactly. Services make up a massive dominant portion of the modern economy, and they are incredibly difficult to deflate once prices rise.
Why is that?
Well, a landlord rarely lowers rent, right? A mechanic rarely lowers their hourly labor rate once it goes up. So the structural recurring costs of living are still compounding.
Completely overshadowing the minor relief in durable goods.
Exactly. And that feeling of being squeezed is vividly, almost painfully captured in the National Federation of Independent Business Data, the NFIB report we're looking at.
Oh man, those numbers were bleak.
Very. Their Small Business Optimism Index for May fell to 95.3.
Yeah.
To put that in context, that is the lowest that index has been since October 2024.
But the metric that really jumped off the page for me was their uncertainty
Yeah,
index.
it spiked to 91.
91. The historical baseline for that uncertainty metric is around 68.
That spike to 91 is incredibly telling. Small businesses are being crushed by what we can call a dual mandate of pain.
A dual mandate of pain. Okay, explain that.
On one side of the ledger, their operational input costs are rising. Because energy is up 7%, their delivery costs are higher. Their utility bills to keep the lights on are higher.
Okay, and the other side?
On the other side of the ledger, the cost of capital, the interest rate on the loans they need to buy inventory or expand their business, remains punishingly high.
So they are completely trapped. But here's another weird contradiction in the data that I'm trying to wrap my head around. The consumer is supposedly feeling squeezed. Small businesses are panicking.
Right.
But the data says people are still spending money like crazy.
They are.
April personal consumption expenditures, or PCE, rose by $111.1 billion. People are still buying things,
Yep.
but at the exact same time, their real disposable personal income actually dipped slightly by $19.9 billion.
Yeah.
How does that math work? How are they spending more if they have less?
It works through leverage and depleted reserves. They are spending money they effectively do not have.
And that cards.
Exactly. They are either running up credit card balances at really high interest rates, or they're aggressively dipping into whatever savings they accumulated over the past few years.
Which creates a deeply unstable dynamic.
Very unstable.
Yeah.
The sustained spending keeps consumer demand artificially high, which in turn keeps inflation sticky and elevated.
Yeah.
Which then traps the very businesses trying to service them in a high-cost environment.
It's a vicious cycle, which perfectly illustrates the absolute nightmare scenario currently facing the world's central banks.
Oh, nightmare is the right word.
If we step back and look at the bigger picture, the central banks are the ones tasked with steering this massive economic ship.
Right.
But because inflation is currently being driven by geopolitical energy shocks like a helicopter crash in the Middle East, which is something a central banker sitting in an office simply cannot control with an interest rate lever, they are essentially paralyzed.
They are completely trapped.
Yeah.
And to see what that paralysis looks like in real time, let's examine the Bank of Canada first.
Yeah, let's go up north.
Their latest monetary policy press release is just a masterclass in being stuck between a rock and a hard place. The BOPC Governing Council just announced their decision to hold their target overnight rate steady at 2.25%.
And this is the fifth consecutive meeting where they have done absolutely nothing.
They are frozen. And when you look at the economic reality in Canada, you understand why Governor Tiff Macklem is having sleepless nights.
Tell me about it.
He is facing a textbook case of stagflationary pressure. According to the release, Canadian gross domestic product, their GDP, actually shrank by 0.1% in the first quarter of 2026.
So the economy isn't just slowing down, it is actively contracting.
And the internals of that GDP report are grim. While there was a slight uptick in consumer spending, government spending unexpectedly declined.
Right.
The housing market activity fell significantly, and crucial business investment remained incredibly weak.
But, and this is a massive flashing red, but despite the entire economy shrinking, CPI inflation in Canada actually rose to 2.8% in April.
Yeah.
So you have a shrinking economy and rising prices simultaneously.
It's the worst of both worlds.
It is. The BAC release explicitly notes this inflation jump was driven by two things. First, higher global oil prices directly linked to that Middle East conflict we discussed.
Right.
And second, a really fascinating statistical anomaly regarding the consumer carbon tax.
Yes, the statistical baseline effect.
Can you explain how that works?
Sure. So last year, Canada eliminated a major consumer carbon tax, which artificially suppressed the inflation data for the subsequent 12 months.
Because things suddenly got cheaper artificially.
Exactly.
Yeah.
But now that we are a year out from that elimination, that artificial dip has fallen out of the rolling 12-month data window, which causes the current inflation rate to mathematically pop back up.
Oh, wow. So this is the trap Governor Macklem is in. Let's walk through his options.
Okay.
Option A. The Bank of Canada cuts interest rates to stimulate that shrinking GDP, to make loans cheaper so businesses will invest and hire people.
Right.
But if they cut rates, they risk pouring pure gasoline on that 2.8% inflation fire, allowing those higher energy prices to become structurally embedded in the Canadian economy.
Exactly. It's too risky.
But option B is equally disastrous.
Yeah, it is.
If they raise interest rates to fight the 2.8% inflation and cool prices down, they risk utterly crushing an economy that is already contracting.
Right. They risk triggering a severe recession in a country where employment is already essentially flat, and the unemployment rate is hovering uncomfortably around 6.6%.
And as if trying to solve that stagflation puzzle wasn't complicated enough, Canadian businesses are also dealing with massive external trade uncertainty.
Huge uncertainty.
The institutional reports highlight that President Trump recently declared he is, quote, not looking to renew the North American Free Trade Agreement.
Yeah.
And again, keeping our strict neutrality here, we aren't debating trade policy, but the market impact of a statement like that is profound.
Oh, absolutely.
If you are a Canadian manufacturer who exports 80% of your goods to the United States, how on earth do you plan your capital expenditures for the next 5 years when you don't even know what the tariff landscape will look like?
You don't. You freeze. You delay building that new factory. You delay hiring those extra workers.
Right.
That trade uncertainty adds a thick, paralyzing layer of unpredictability to the market. Even positive physical infrastructure developments are getting bogged down. Well, the reports note that Canadian Prime Minister Mark Carney has been discussing the impending opening of the Gordie Howe International Bridge, which is a massive trade corridor.
Right, connecting Detroit and Windsor.
Exactly. But even that is clouded by reports of lingering security protocols and technical details delaying the physical opening. The friction in the economic system is just palpable everywhere you look.
So the Bank of Canada is essentially forced to adopt a neutral, wait-and-see stance, holding their breath and hoping the energy shock proves to be transitory.
Yeah, they have their hands tied.
But while Canada sits on its hands and waits, the central bank south of the border is undergoing a massive structural earthquake.
Yeah, let's pivot to the U.S. Federal Reserve.
Let's do it.
If we rewind the clock to the start of 2026, the market was gleefully, almost arrogantly, pricing in multiple interest rate cuts for the year.
Everyone thought the war on inflation was won.
Exactly. They thought the era of cheap money was coming back.
They were entirely wrong. Following that 4.2% inflation read we discussed, combined with a labor market that refuses to break, bond traders have completely capitulated. They have priced out any rate cuts for 2026.
It's wild to see how fast sentiment shifted.
It is. In fact, if you look at the CME FedWatch tool, which tracks the probability of future Fed moves based on futures contracts, it currently shows a greater than 50% probability of a rate hike by December.
A rate hike.
Eh.
From expecting 3 cuts to bracing for a hike, that is massive whiplash.
But the repricing of interest rates is only half the story. The real earthquake is the profound leadership transition happening at the Fed.
Right.
On May 22, 2026, Kevin Warsh was officially sworn in as the new chairman of the Federal Reserve, succeeding Jerome Powell.
And this is not just a change in personnel.
No.
The institutional reports are making it very clear that this is a total change in philosophical governance. Warsh has historically been a fierce, vocal critic of exactly how the Fed communicates with the financial markets.
To understand why this matters, we really have to explain the communication architecture of the Powell era.
Let's do that.
For years, the Fed relied heavily on a tool called forward guidance.
Right. Let's break that down. Forward guidance is basically the Federal Reserve telling Wall Street exactly what they plan to do months and months in advance.
So that absolutely nobody gets surprised.
Exactly.
I always think of it like having a high-end GPS navigation system for the stock market.
That's a good way to look at it.
The Fed looks at the road ahead and tells investors, okay, in exactly 3 months, we are going to turn left and lower interest rates by 25 basis points.
That is a perfect analogy. The entire goal of forward guidance was to suppress market volatility. The Fed didn't want sudden panics.
Right.
They even institutionalized this with a tool called the Summary of Economic Projections, which everyone on Wall Street just calls the dot plot.
The famous dot plot?
Yes.
Oh.
4 times a year, every single Fed official would literally place a dot on a chart to show exactly where they believed interest rates would be at the end of the year, next year, and 3 years out.
They were showing the market their exact playbook.
Completely transparent.
But now, the report suggests that Chair Warsh is systematically dismantling that entire communication system.
He is.
He believes it creates a moral hazard, where the market relies too much on the Fed's promises instead of evaluating actual economic data.
Right.
So, he is expected to completely kill the dot plot at the upcoming June 16th FOMC meeting.
That's huge.
He is going to strip out the traditional bias language from the policy statement.
He is embracing what economists call strategic ambiguity.
Okay, so sticking with our analogy, Warsh is basically turning off the screen on the dashboard, tossing the GPS out the window while driving down the highway and telling the market to just watch the road?
Yes, effectively.
My question to you is mechanically, what actually happens to bond investors and equity traders when the central bank suddenly embraces this strategic ambiguity?
Mechanically. The immediate result is fear, and fear is priced into the market as yield.
Okay, explain that.
When you remove the GPS, the driver has to become hypervigilant. Without the Federal Reserve holding the market's hand and telegraphing its every move, volatility naturally, inevitably spikes.
Because they don't know what's coming.
Right. Investors can no longer price in a guaranteed safety net. Capital becomes incredibly defensive.
Because if you don't know what the Fed is going to do tomorrow, taking a risk today is mathematically much more dangerous.
Exactly. And you saw this instantaneous repricing of risk in the bond market this week.
What happened?
The U.S. Treasury held an auction for 10-year notes. Because investors are now operating in the dark without forward guidance, they demanded a much higher return to compensate for that uncertainty.
They wanted a premium.
Right. The Treasury had to offer a high yield of 4.468% just to attract buyers.
They had to pay a premium just to get people to buy government debt because everyone is terrified of what Warsh might do next.
Exactly.
And this defensive, jittery posture in the bond market perfectly sets the stage for the dramatic equity sell-off we saw on Wednesday, Juneteenth. The market was a sea of red.
It was brutal.
The S&P 500 dropped 0.90% by midday. The Dow Jones Industrial Average dropped over 600 points. And the tech-heavy NASDAQ slid 1.30%.
But here is where we have to connect the macro environment to a highly specific, unprecedented micro event.
Oh, yeah.
Because the sell-off isn't just about Kevin Warsh throwing out the GPS, and it isn't just about inflation staying high.
No, it's not. And this brings us to a fascinating mechanical dynamic in the markets right now.
It really is.
In this specific environment we've just outlined where interest rates are high, the central bank is embracing strategic ambiguity, and general liquidity in the system is incredibly tight. A massive, unprecedented new gravitational force has suddenly appeared, and it is violently vacuuming up whatever loose cash is left in the entire financial system.
We are talking about the ultimate black hole of capital, the SpaceX mega IPO.
The numbers attached to this event are just, well, they're almost difficult to comprehend. Let's lay out the raw specs.
Go for it.
SpaceX is officially listing on the NASDAQ exchange this Friday, June 12th. They will trade under the ticker symbol SPCX. They are offering exactly 555,555,555 Class A shares to the public, and they have set a fixed offering price of $135 per share.
If you do the math on that share count and price, it means SpaceX is looking to raise $75 billion in raw liquid capital in a single day.
$75 billion.
Yes. That massive cash raise places the implied enterprise valuation of the entire company somewhere between $1.75 and $1.77 trillion.
Trillion, with a T.
Yeah.
Just to put that in perspective for you, the previous global record for an initial public offering was the Saudi Arabian state oil company, Saudi Aramco, back in 2019.
Right.
They raised $29.4 billion, and everyone thought that was an untouchable record.
And SpaceX is nearly tripling it.
SpaceX is trying to nearly triple the largest IPO in the history of human civilization. And what is truly wild is that the demand is absolutely rapid.
The institutional reports we have highlight that indicative demand, which is the amount of money institutional investors have formally signaled they want to invest, has already exceeded $250 billion.
$250 billion of demand.
Yeah. The offering is nearly 4 times oversubscribed before it even opens.
And this overwhelming demand is causing what market analysts are brilliantly calling the IPO tax.
It's a great term.
I want to spend a minute here because the mechanics of this are so fascinating. How does a hedge fund actually execute the so-called tax?
Well, it is a massive forced reallocation of global capital. Imagine you are a portfolio manager at a major hedge fund.
Okay, I'm a portfolio manager.
You know that SpaceX is a generational asset, and you desperately want a massive allocation of those shares at the $135 offering price.
Right.
But your fund is already fully invested. You don't have $1 billion in cash just sitting in a checking account.
Right, my capital is deployed. It's doing work.
Exactly. So to get the cash to buy SpaceX, you are forced to sell something else. You have to liquidate your current holdings.
And what do they sell?
They sell their highly liquid, high-beta technology stocks, and they sell their highly sensitive digital assets.
Wow.
We saw exactly this dynamic play out. In the days leading up to this IPO, Bitcoin suddenly dropped to $61,845.
The broader cryptocurrency market lost over $180 billion in value in a matter of days.
Yes.
Wait, let me make sure I'm wrapping my head completely around this IPO text.
Sure.
You're telling me that a hedge fund manager who historically loves Bitcoin, who believes in Apple or Microsoft stock, is actively dumping those assets, which drives their market prices down, not because he suddenly thinks they are bad investments,
No.
or because the fundamentals changed,
Right.
but simply because he is essentially scraping the institutional couch cushions for cash to buy Elon Musk's space stock.
That is precisely what is happening. It is a pure liquidity vacuum. Yeah. The demand for SpaceX is so immense that it is actively draining capital out of the rest of the financial ecosystem.
It's a profound capital migration.
It really is. And what makes this IPO even more unprecedented isn't just the sheer size of the cash raise. It is how the offering is fundamentally structured, particularly regarding retail investors and the underlying corporate governance.
Yeah, let's look at the retail angle first, because this is being heavily marketed to the public.
Very heavily.
Usually when a giant, hype-driven company goes public, the big Wall Street banks, the Goldman Sachs and Morgan Stanleys of the world, they gobble up all the shares at the initial IPO price.
Right.
The average retail investor, you and I, we have to wait until the stock is actually trading on the open market, usually hours later, and by then the price has skyrocketed to a massive premium.
It is historically an exclusionary process.
Exactly. But SpaceX is deliberately changing the playbook. They are explicitly reserving up to 30% of the total IPO allocation specifically for retail investors.
Yeah, 30% is huge.
They are doing this through popular brokerage platforms like Fidelity, Charles Schwab, and Robinhood.
And the public relations narrative surrounding this decision is framing it as a grand democratization of finance.
Of course they are.
They are claiming to allow the everyday retail supporter, the people who have watched this Starship test flights on YouTube for years, to participate on the ground floor alongside the institutional giants.
However, there is a massive hidden catch embedded deep in the structural architecture of the stock itself. And it has to do with voting rights.
The dual-class voting structure.
Yes.
This is absolutely critical for anyone considering this stock to understand. If a retail investor buys a share of SPCX on Fidelity, they receive a Class A share.
Okay, Class A.
That Class A share carries exactly one vote in corporate matters. But Elon Musk and a select group of key early insiders hold Class B shares.
And what do those do?
Those Class B shares carry 10 votes per share.
10 to 1. So the math on that means that post-IPO, after raising $75 billion from the public, Elon Musk will still personally retain 82.4% of the aggregate voting power of the entire company.
That's right.
He will simultaneously serve as the chief executive officer, the chief technology officer, and the chairman of the board.
Yeah.
Because of this extreme concentration of power, SpaceX will legally be classified as a controlled company.
And that classification is not just semantics.
No, it's not.
Being a controlled company legally exempts SpaceX from standard stock exchange mandates that require a company to have a majority of independent directors on their board or independent compensation committees.
They are essentially standing in front of the public markets, asking for $75 billion in cash, while explicitly looking investors in the eye and saying, you have absolutely no say in how this company is run, who is on the board, or what we do with your money.
Basically, yes.
And this highly aggressive structural quirk is actually causing a massive rift between the major stock indexes.
Yeah, the exchanges are reacting very differently to this unprecedented entity.
Let's talk about NASDAQ first.
The NASDAQ exchange is rolling out the red carpet. They're granting SpaceX fast entry into the NASDAQ 100 index after just 15 trading days.
And explain why fast entry matters so much for the stock price. Why is that a big deal?
It matters because of passive investing. Millions of people have their retirement accounts in index funds that simply track the NASDAQ 100.
Right.
When a massive company like SpaceX is added to that index, those passive funds are mathematically forced to blindly buy the stock, regardless of the price or the fundamentals, just to accurately reflect the index weightings.
It guarantees billions of dollars of automatic price-agnostic buying pressure.
Exactly.
But while NASDAQ is forcing index funds to buy, the S&P 500 Index Committee took a completely different approach. They completely denied SpaceX fast-tracked entry into the S&P 500.
And for a very specific reason. The S&P 500 has much stricter traditional inclusion rules. Specifically, they require new constituents to demonstrate GAAP profitability.
What does that stand for again?
That stands for Generally Accepted Accounting Principles. They demand to see a history of actual, undeniable profit. And SpaceX simply does not meet that criteria. In fact, if you dig into the raw S1 financial filings, the numbers are jarring. Despite generating an impressive $18.67 billion in revenue in 2025, which was primarily driven by the massive success of their Starlink satellite internet service, SpaceX posted a staggering net loss of $4.9 billion for the year.
Okay, here's where it gets really interesting and where I think we need to ask the uncomfortable question.
Let's ask it.
You have a company demanding a $1.75 trillion valuation. They are bleeding nearly $5 billion a year in net losses. And the founder is retaining absolute dictatorial control over the board of directors, is reserving 30% of these shares for retail investors, truly a noble democratization of finance, allowing the little guy to get rich.
Oh.
Or are everyday people essentially being invited to the party simply to serve as exit liquidity, funding a massive, unsustainable cash burn so early venture capitalists can cash out?
That is the defining ethical and financial question of this entire IPO.
Yeah.
And to truly answer it, we have to look past the rockets.
Right, because it's not about rockets.
We have to look at exactly why SpaceX lost $4.9 billion in 2025. Because the losses didn't come from building Starship or launching satellites. That side of the business is highly operational.
Very successful.
The massive loss is directly, exclusively tied to their artificial intelligence division.
Right. If we look back to February 2026, SpaceX executed a massive all-stock transaction to completely absorb xAI, Elon Musk's artificial intelligence startup, which is now rebranded internally as SpaceX AI.
Yes.
And this is where the entire narrative of our episode connects. Because building state-of-the-art AI is not like building a traditional software app in 2015.
Not at all. It is astonishingly physically expensive.
According to the S1 filings, SpaceX AI is currently burning through approximately $1 billion every single month.
$1 billion a month.
It's an incinerating cash. And what are they spending it on? They aren't paying a bunch of coders to type on laptops. They're buying physical hardware to construct orbital computing infrastructure and massive terrestrial data centers.
And that extreme capital intensity is the vital link to the broader market sell-off and the central bank anxiety we've been discussing. We are witnessing the definitive end of the asset-light software era.
Explain the asset-light era for context.
Well, for the last 15 years, software companies enjoyed massive, almost magical profit margins. Why? Because once you pay a developer to write the code for an app, replicating that code and distributing it to a billion smartphones costs almost nothing. The overhead was minimal.
You just rent some server space on Amazon Web Services and you're a tech giant.
Exactly. But AI is different. AI does not scale for free. Training and running these massive language models requires an astonishing amount of physical capital.
Physical capital.
You need specialized, incredibly expensive semiconductors, specifically NVIDIA GPUs. You need to build massive physical data centers to house them. And you need gigawatts of actual electricity to power and cool those data centers.
Our institutional reports have coined a brilliant term for this transition. The SpaceX.
It's a very fitting name.
The apocalypse for software as a service. The entire technology sector, which used to be praised for its lean operations, is now bleeding cash trying to buy enough physical GPUs to build the infrastructure needed to run the AI future.
Yep.
And SpaceX is at the absolute bleeding edge of this capital burn. They are currently building a massive physical data center called Colossus One in Memphis, Tennessee.
Huge facility.
And the major tech players, the hyperscalers, are so desperate for computing power that they are signing unthinkable contracts just to rent space in it.
We could see that desperation quantified in the S1 disclosures. Anthropic, one of the leading AI labs, signed a binding deal to pay SpaceX AI $1.25 billion per month to secure the entire computing capacity of the Colossus One facility.
$1.25 billion a month, just to rent it.
Yes. And Google signed a separate agreement to pay $912 million monthly just to access a specialized cluster of 110,000 NVIDIA GPUs at the same facility.
Google is effectively writing a nearly billion-dollar check every 30 days just to rent a warehouse full of specialized silicon. It is mind-blowing.
It is.
But it perfectly illustrates the infrastructure paradox that is currently hitting legacy tech companies. And there is no better example of this than Oracle.
Oh, Oracle is fascinating right now.
Let's look at Oracle Corporation. They are reporting their Q4 fiscal 2026 earnings today, and they have become the absolute poster child for this AI infrastructure crisis.
Well, on paper, if you only look at their top-line demand, Oracle looks unstoppable. They have an unimaginable $553 billion paper backlog.
553 billion.
Yes, these are what accountants call remaining performance obligations, or RPOs.
Okay, break that down for me.
It means Oracle has signed binding contracts with customers who want to buy cloud and AI services, but Oracle simply hasn't fulfilled the services yet.
Okay.
Based on this massive demand, they are aggressively projecting to hit $90 billion in total revenue by fiscal 2027.
But as we've established, paper contracts for AI services do not magically equal physical infrastructure.
No, they do not.
To actually fulfill that $500 billion backlog, Oracle has to physically build the data centers. They have to pour the concrete, run the fiber optics, and buy the GPUs.
Right.
And their forward guidance projects a massive capital expenditure program, CapEx, of $50 billion for fiscal 2026.
$50 billion in pure physical spending.
It's like having a wildly popular new restaurant.
Okay.
Let's go back to that analogy I used at the very beginning.
Yeah, the restaurant.
You have a line of hungry customers wrapping around the city block. They're holding cash in their hands, ready to eat. You have the greatest menu in the world.
Right.
But you literally do not have a kitchen. You have to take out a massive billion-dollar loan at 5% interest just to buy the commercial stoves, the deep fryers, and the raw ingredients before you can cook a single meal for that line of people.
Yeah.
At what point does a $500 billion paper backlog become a terrifying financial liability rather than an asset?
Well, it ceases to be an asset and becomes a severe liability the moment the cost of servicing the debt you took on to build the kitchen exceeds the cash flow generated by the actual meals you were selling.
Wow.
And Oracle is currently dancing on that incredibly dangerous razor's edge. Because of this massive $50 billion CapEx build-out, their trailing 12-month free cash flow is deeply, deeply negative.
How negative?
We are talking minus $24.7 billion.
Let's repeat that for emphasis. One of the largest software companies in the world is burning almost $25 billion in cash over a 12-month period just trying to build the physical pipes for AI.
Exactly. And how do you fund a $25 billion cash hole?
You borrow money.
Yes. Their non-current debt has ballooned to a staggering $124.7 billion.
That's a staggering amount of debt.
And remember the macro environment we discussed in sections 1 and 2. We are in a high interest rate environment because the Federal Reserve is embracing strategic ambiguity and inflation is sticky.
Right. Capital is expensive.
Exactly. In that environment, carrying $124 billion in debt is incredibly, suffocatingly expensive. The reports show Oracle is currently paying $1.18 billion every single quarter just in interest expenses.
Just on interest. Over $1 billion every 3 months that simply evaporates to service debt.
Go on.
That is capital. It cannot be used for research. It cannot be used for development. It cannot be paid out as dividends to shareholders.
None of it.
And the financial strain of carrying that debt while building out this physical infrastructure is forcing drastic, brutal corporate measures. Just to free up cash to buy more NVIDIA chips, Oracle recently laid off between 20,000 and 30,000 employees.
It is a devastating human cost. They're literally gutting their traditional workforce, firing thousands of people simply to free up the capital to buy physical hardware.
And Oracle isn't the only tech giant suffocating under the crushing weight of this physical infrastructure demand.
Not at all.
Look at Supermicrocomputer, or SMCI. Their stock just plummeted 18.4%, and it actually closed down over 23% on Wednesday.
Yeah, SMCI's story is almost tragic in a purely corporate operational sense. Their entire business is building the highly specialized physical servers that house these incredibly hot, power-hungry AI chips.
Right, they build the racks that go in the data center.
Exactly. And because of the AI boom, they have a massive $39 billion order backlog. Hyperscalers and tech companies are practically begging SMCI for servers.
Which sounds great.
But SMCI literally does not have the liquid cash on hand to buy the raw components, the silicon, the cooling pipes, the metal, to build the servers they have already legally sold on paper.
So what do? How do they get the cash?
They are forced to go back to the public markets. They announced a highly dilutive $7 billion equity raise.
Hold on, let's translate dilutive equity raise for a second, because that sounds like dry finance jargon, but it is actually a brutal move for investors.
It is.
SMCI is essentially printing new shares of stock out of thin air, right?
Yeah.
And then selling them to raise $7 billion in cash. Which mathematically means that the slice of the corporate pie that current investors own just got significantly smaller. Their ownership is diluted. The company is actively punishing their current believers just to raise the cash to buy hardware parts.
That is exactly what it means. It perfectly highlights a critical, terrifying vulnerability in the entire AI supply chain. Paper demand means absolutely nothing if you lack the physical, liquid capital to execute the build-out.
And while the tech sector is burning through cash, diluting their shareholders, and firing tens of thousands of workers to buy GPUs, we are seeing a fascinating, massive behavioral shift in where institutional money is choosing to hide.
Yeah.
Capital is actively fleeing the high-burn, high-risk AI sector and seeking safety in traditional, validated, boringly profitable sectors of the economy.
We see this flight to safety clearly in the mergers and acquisitions space this week. During this exact same volatile period where tech stocks are bleeding, Danaher Corporation, a massive medical and industrial conglomerate, smoothly completed its absorption of Masimo, a specialty medical diagnostics provider. It was a clean, logical acquisition of physical cash flows.
And we also saw the UK pharmaceutical giant GSK formally acquire Nuvalent, which is a clinical stage cancer drug developer, for $10.6 billion in cash.
And the market loved it. Nuvalent's shares surged 39.3% on the news of the acquisition.
Wow, that's a huge bump.
What this shows us is that institutional investors still have a massive appetite to deploy capital. They still want to buy companies.
But they're picky now.
Very. They want targeted, clinically validated platforms. They want clear, understandable paths to profitability. They are increasingly rejecting the highly leveraged, cash-burning promises of future AI dominance in favor of boring physical reality.
If we pull back and connect everything we've talked about today, the entire narrative is one of massive compounding pressure. Let's trace the causal chain for the listener, from the physical world all the way to the stock ticker.
Sure. If we connect this to the bigger picture, it starts with raw geopolitics. A helicopter crashes, military friction escalates in the Middle East near the Strait of Hormuz. That physical friction threatens maritime shipping, which restricts the flow of global oil, causing energy prices to instantly spike.
Right. And those higher energy prices bleed directly within weeks into the CPI data.
Yep.
It drives headline inflation up to 4.2%, squeezing consumers who are already relying on credit cards and completely crushing the optimism of small business owners who face a dual mandate of rising costs and expensive debt.
And because inflation remains stubbornly, structurally high due to those energy shocks, the central banks like the Bank of Canada and the Federal Reserve are completely trapped.
They're paralyzed.
The Bank of Canada has to watch its economy shrink while prices rise, paralyzed by stagflation.
Yeah.
The Fed is forced to abandon rate cuts, pivoting toward rate hikes. And by removing their forward guidance, the Fed injects strategic ambiguity and terror into the bond markets.
Which means money itself becomes incredibly expensive to borrow, yields spike. And that brutal reality of expensive capital collides head-on with the AI boom, an industry that requires more physical, capital-intensive infrastructure spending, data centers, power plants, gigawatts of electricity, specialized silicon than the lightweight software era ever dreamed of.
The legacy tech giants like Oracle and SMCI are being violently forced to take on massive, high-interest debt or dilute their own shareholders just to build the physical foundries of the AI age.
Yeah.
This results in negative free cash flows, massive corporate layoffs, and a flight of capital towards safer, traditional sectors.
And finally, right into the middle of this liquidity-starved, terrifying, high-interest rate environment steps SpaceX.
The black hole.
They launch a historic, unprecedented $75 billion IPO that acts as a massive vacuum, siphoning whatever available capital remains out of the broader market, crushing crypto and tech stocks in the process.
It's pulling everything in.
And concentrating all that wealth into a single, highly controlled entity where the public has absolutely zero voting power.
It is a profound, fundamental structural shift in how capital flows through the global economy.
It truly is. And that brings us to our final provocative thought for the day. For the last 15 years, when we used the phrase big tech, we meant something very specific.
Yes.
We meant asset-light software. We meant frictionless app stores, endless scaling with zero marginal cost, and an ocean of cheap venture capital.
The golden era of software.
But I want you to look at the landscape today, in June 2026. Look at SpaceX deliberately burning $1 billion a month to physically construct orbital supercomputers.
Right.
Look at Oracle, carrying $125 billion in suffocating debt, firing 30,000 human beings just to afford the concrete and cooling pipes for physical data centers.
Look at SMCI.
Exactly. Look at Supermicro desperately diluting their own stock just to buy server racks. The technology giants of 2026 look less and less like the agile, lean software startups of the 2010s.
They really do.
Instead, they look incredibly similar to the heavy industrial titans of the 19th century. They look like the railroad barons and the steel magnates who had to borrow billions of dollars, taking on massive risk to build literal power plants, lay thousands of miles of physical track, and construct massive supply chains.
The physical world always wins.
Are we witnessing the definitive death of the software company as we knew it? And are we watching the rebirth of the 19th century heavy industry titan just wearing a modern silicon mask?
That's a great question.
As you watch the SpaceX ticker go live on the NASDAQ this Friday, and as you watch billions of dollars violently flow toward a single company, I encourage you to ponder that question. Because the financial tools we used to diagnose a healthy tech company 5 years ago might not just be giving us static today.
It might be completely obsolete.
They might be looking at a completely different kind of corporate anatomy entirely. Thank you for joining us on this deep dive into the sources. We will catch you next time.